Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman, live from our New York City headquarters. Stocks are mixed with the S&P 500 as well as the NASDAQ aiming for a fourth straight day of gains. Here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
There's one issue that every investor should be paying attention to, and that is guidance. Now, managements have no incentive to provide guidance because they have the perfect excuse in the tariffs. But we are hearing teams, management teams saying things like we're upholding or we're raising our guidance in the current tariff environment. The problem is nobody knows what that actually means.
I would say this is the first quarter that we've heard them talk about the benefits from AI overall. We've been in a wait and see mode for some time, just given their overall, investment in Gemini, in search, in AI, and the list goes on and on. Frankly, what we heard this quarter was actual search revenue grew 10%, thereabouts. That's a positive. It's better than we were expected.
You just saw an announcement today about Apple saying they were going to be making iPhones in India. And if you look at the most strategic partnership to the U.S. over this next decade, it will be India. They tease about America and India being AI. Modi said that very directly in terms of the opportunity. So I think you will see iPhones being made in India, less in China, and you'll see iPhones being made in the U.S. and strike the balance on it.
We got 1 hour to go until the market close. I'm joined by Lou Bathenese, the BigSkinny.com founder and Prairie Operating Company Executive Vice President of Market Strategy. He's going to be hanging with me for today's show. So let's take a look at what's going on here in markets today. And a relatively quiet day compared to what we've been seeing recently. The Dow not quite making it in terms of making it these 4 straight day of gains, at least not right now. We could.
Hey, I'll take 4 as opposed to 1.
Yeah, exactly. Right now, it's very little change. The S&P 500 is up about 0.6%, and the NASDAQ's up about 1.1%. Now, we did get some more tariff headlines, sort of, and some commentary, right? There was an interview with Time Magazine with President Trump that was released this morning, and then he did make some comments this afternoon, but none of it shed much clarity. He kind of says there's stuff coming.
Yeah, I think it's indicative of any negotiation, right? You allude to coming to an agreement and then you go back the other way. So I think there's some good cop, bad cop going on between the president and Scott Bessent. And for investors, unfortunately, it's just the life we have to live with, right? There's no clarity until there's the finality in terms of it.
And it's just still confusing, too, when the president says, he's sort of left it ambiguous about whether he's talked to President Xi. He says, I've talked to him lots. But it sounds like he probably hasn't talked to him since he imposed the tariffs.
Right. And I hate to say it, but we're stuck in this situation right now. I just don't. Do we get resolution in 90 days? I think you absolutely have to, because if we get past that, you start really talking about economic knock-on effects that the president, he can't just solve by badgering or jawboning Jerome Powell to cut interest rates. Right. So I think there's a definitive window here. Expect volatility. I mean, 4 days of up I'll take that out of 5.
Sure. Yeah. So let's look at the week real quick. There's the NASDAQ up 6.6%, the S&P 500 up 4.5%. And I would say also with regard to this window, it feels like the window's already done. In other words, there's already economic damage being done right now and yesterday and the day before that. I mean, anecdotally, I'm hearing about it. I'm sure you're hearing about it too.
Yeah, no, there's definitely, and I think you're seeing it starting to show up in the hard data, or you're seeing kind of front loading of orders and inventory and anticipation of weakness coming. You can't have that keep stacking up. I mean, prior to this week, we had all the soft anecdotal data that didn't indicate that we're definitely there yet. I think you're starting to cross that transom now, where you're going to see it more and more in the data, in the employment reports, in consumer sentiment today was, it was a little bit better revision.
But what people are expecting for their financial conditions 12 months from now was terrible.
Yes, and the inflation picture is terrible still too.
Yes, exactly. Just looking at some of the movers that I want to point out here today, we got to point out what's going on with Alphabet, because that's part of the story this week too. Even though Alphabet didn't report until yesterday, still feel the sort of optimism that we're coming into this period where big tech is going to report and maybe we'll be less pessimistic about the outlook?
Big sigh of relief, and I'm full disclosure, an Alphabet shareholder.
We're going to talk about it more later.
Yeah, but Tesla was last week, right, and was just a total disappointment. So I love seeing this green in the big tech screen.
Yeah, it is
right?
interesting to see Tesla up 10% today. We're going to, as I said, we're going to talk about it later. Don't want to give too much away right now. And then NVIDIA also, we should point out, is up better than 4%. And as we always remind folks, NVIDIA doesn't report on the same cadence as everybody else.
Correct.
We have to wait longer to hear from them, but nonetheless interesting.
And chips for in the last 5 days, the chip sector as a whole has been up about 9%. So you're seeing good follow through in various areas of tech.
Yeah, just a quick check on those chips over the 5-day period. You can see some of the gains for NVIDIA, 9%, Broadcom up 12%, and TSM up almost 9%. Let's talk more about the latest market moves now. For that, let's welcome in David Wagner, Aptus Capital Advisors portfolio manager. David, it's good to see you. And I know one of the things at your firm that you guys think about is risk management and mitigation. And you just heard what Lou and I were talking about, where right now we are in this kind of stuck period. But how are you thinking through, considering how much we don't know, how are you thinking through that risk management and mitigation?
Yeah, Lou, Julie, thanks for having me back here. That's exactly what Aptus's bailiwick is. It's trying to own volatility as an asset class, because we're firm believers that, fixed income, which has kind of been the ballast of safety and allocations, historically speaking, for the last 40, 50 years, it may not be that ballast if we look through the windshield moving forward, that we might see a positive correlation between stocks and bonds moving forward in the future. So I think if you can sprinkle in some volatilities in asset class through long puts or other long vol mechanisms, it's the best way to play this market. Because as you guys are just speaking about right now, the market may be in a lull for a little bit, but we're really going to find out what happens to these tariffs with that 90-day extension here just in a few months. And we want to make sure that all of our allocations are very much prepared.
Yeah. David, speaking about risk management, do you think that corporate executives should be managing risk a little bit more in terms of guidance revisions, being more transparent, maybe being more cautious and revising more negatively to the downside just to prepare for maybe worst case scenarios instead of middle of the road? Are you surprised by those revisions or lack thereof?
I think that's the million-dollar question heading into this earnings, because obviously Q1 is what we're reporting right now. A whole lot of the tariff jargon wasn't going on in the first 3 months of the year. Obviously, Liberation Day was on April 2nd. So everyone should try to figure out what this overall guidance is right now. But Luke, you bring up a good point. I wouldn't bet against the resiliency of corporate America. We learned that during the financial crisis. We obviously learned it during COVID. So I have full faith in the mainstreams to make the right decisions moving forward. If I was a CEO, I would just maintain guidance and maybe expand the bounds of guidance just slightly, because there's still a lot of unknown in the next few months. But I wouldn't make a whole lot of changes in the near term, just because this is still just the first quarter. We still have 3 quarters remaining left in the year.
It's interesting. We've heard a lot of companies being very specific about their guidance too, which I found really fascinating throughout earnings season, where they are really quantifying very specifically, okay, here's the hit potentially related to China, related to other regions, et cetera. That way they have sort of some flexibility to say, okay, it wasn't as bad, so we can take that off. That's been an interesting development. David, you talked about the resiliency of corporate America. What about the resiliency of consuming America, right? Which has really been the thing that over the past few years, as there were predictions of a recession, people kept spending. But it feels like now already that Americans are starting to pull back. If you look at travel data, for example.
Yeah, no doubt. I mean, that's the other million-dollar question, I guess, that's out there is all that soft data that we've seen, the survey sentiment data, is that going to transition into hard data? One thing we've been telling our clients, and it's probably not a popular take, is that there's no better time than, the United States to implement tariffs right now. If you look at from a consumer standpoint, just going back 2 months ago, consumer spending was growing at 6.5% year over year. Obviously, you have to look at that number in context from a historical perspective. And historically, the consumers have spent, between 3 and 5.5% on a year-over-year basis. So we're kind of already out kicking our coverage from a consumer spending perspective. That number's come down a little bit, but investors' balance sheet, in my personal opinion, still remains very strong. If you go back over the last 10 years, the net household net wealth has increased by 100% since pre-COVID. It's still up 40%. So it's hard for me to bet against corporate America. It's hard for me to bet against the propensity of the consumer to spend right now, because they're still spending right now, even though the soft data kind of says that may slow down in the near term.
And it's interesting to hear you say that, especially about sort of there being no better time for tariffs. I think a lot of people would quibble with that particular part of your statement, David. Let's get to strategy for a moment, okay? So where are you seeing then, if not opportunity right now, or maybe you are seeing opportunity, but where are you seeing places to go maybe that will see less damage?
Yeah, I think we can take a look at that from two different perspectives. One from an allocation standpoint, but also then from like what do I like within the market? And right now within the market, I love small caps and I love the mega cap names. Actually, I love barbelling that strategy. The CapEx spend on the mega sense that continues. We saw that yesterday with Google, and then you kind of play a valuation side on the other side of that barbell by any small caps. But from an overall asset allocation standpoint, I did just mention that we're not bullish on bonds. It's not the ballast moving forward. But one big thing that we do here at Aptus is one of our mentalities that we want to do better in the tails. And in fact, heading into this year, my outlook for the market was based off the 1980s movie Airplane. So it kind of plays into the fact, like, can the Fed land the plane on a run rate that's getting smaller, but also like tails are going to occur in this market moving forward more often than what we're accustomed to. This year, probably this decade alone, we've seen 20% intraday pullbacks by the S&P 500. Just seeing two within the first 5 years of a decade is basically unprecedented. But moving forward, I think given the newfound characteristic within the S&P 500 and its operating leverage, in my opinion, obviously the top 10 stocks account for 38% of the benchmark, and they own that characteristic of operating leverage. And when operating leverage is working for you, you have great stock market returns like you saw in 23 and 24. But when operating leverage cuts against you, you can see some returns that we've seen here in 2025, because obviously the market hates when the possibility of slowing growth occurs and also profitability. And when operating leverage cuts against you, it hurts the overall growth trajectory and also margin. So I think that's how you have to think about allocations moving forward. It's like, hey, how can I do well in right tail events, but also left tail events?
Yeah, David, I want to lean in on small caps a little bit. I've been pounding the table on small caps early and often, which means I've been wrong. So I want to, as a fellow commiserator in that space with you, that's a believer, what do you see as the catalyst and the setup for small caps in this market?
Lou, I love the optimism you have. Small caps, I've run a small cap strategy for 12 years right now. And it's just really been an asset class that everyone has absolutely hated. Like, nothing's been able to work for. Like, even when the market started to broaden earlier on this year within, the S&P 493 and international area, like, small caps weren't invited to the party. Exactly. Everyone expected like small caps can work when rates come down, which we saw at the beginning part of this year. Small caps didn't perform well at all during that period of time, just because like that R word just keeps getting tossed around, and that just stands for recession. And when that R word gets tossed around, like, people could care less about valuation for small caps or performance. I think for small caps to work, you do need to see interest rates come down slightly. But also, I think you need to see growth really start to inflect, which is something that hasn't happened over the last few quarters. Some analysts are calling for that for the equilibrium between large cap growth and small cap growth to happen in the second half of this year. That keeps getting pushed out. But Lou, for small caps to work, you just have to have growth really start to come back within the smaller cohort of this market.
Man, you guys are on an island with this one. I'm not joining you on, but I hope you have good cocktails there. David, thank you so much for joining us. Appreciate it.
Thanks, y'all.
We're just getting started here on Market Domination. Coming up, another round of earnings this morning means more companies lowering or pulling their guidance. We'll get you the latest on the other side. Plus, retail among the sectors facing an uphill battle navigating President Trump's trade war. We'll speak to an expert later about the impact that consumers could start seeing. Stick around, much more Market Domination still to come. Welcome back to Market Domination, sponsored by Tasty Trade. We have been on daily tariff watch this earnings season. Let's round up some of the latest commentary from companies. We've seen multiple companies, of course, cutting their full year guidance this week. Procter & Gamble, Pepsi, Kimberly-Clark. Colgate-Palmolive becoming one of the latest names to lower its outlook for the year due to President Trump's tariffs. CEO Noel Wallace saying on the earnings call this morning that the impact of tariffs in 2025 will be roughly $200 million. The CFO elaborated further on the impact on the call, saying, quote, the incremental impacts are primarily tariffs on raw materials and finished goods coming from China into the U.S. and from the U.S. into China, because, of course, a company like Colgate-Palmolive also sells into China. And more companies pulling guidance, including Skechers. That shoemaker reporting first quarter earnings yesterday, withdrawing its 2025 guidance due to macroeconomic uncertainty. The Skechers CFO saying on the earnings call, quote, with an effective tariff rate at about 159%, products from China to the U.S. are prohibitively expensive. And then there's Carter's, the children's apparel company, also suspending its forward guidance in light of tariffs. The company does still have some exposures from tariffs on China, but it has been, over the past several years, been making a push to expand its supply chain operations to other countries. The CFO saying on the call, quote, we now have a broadly diversified production base. Vietnam, Cambodia, Bangladesh, and India represent our largest countries of origin. Lou Bassany's still with me here, and that's just like a sprinkling, a slight sampling. Obviously, everyone is being asked about it on the conference calls. We were just talking about it with David Aptis, our portfolio manager, and you guys were discussing like what is the duty of companies?
Yeah, I think
what
that's the right
do you
word.
want to hear from companies in terms of how they're thinking about
so
this stuff?
while David and I agree on small cap, I'm going to deviate from the point where he said, hey, let's not go too fast to change revisions. Don't underestimate the resiliency of corporate America. But I think the duty of executives right now is to be transparent and say there's complete uncertainty. I mean, how do you have a model that can calculate your tariff impact for a tariff that one day is 20%, the next day is 35%, and maybe 3 weeks from now could be 0%, right? So I think I would be of the conviction from the communication standpoint, let's flush out all the bad news, right? Like how bad could it get? So we've seen a couple companies that give twofold guidance now. Here's guidance, no tariff impact, tariff impact. I think that's a responsibility to shareholders.
Yes.
Give them what could be the potential impact. And then in the back half of the year, then you can just adjust expectations. Hey, it wasn't as bad as we thought, because
it's better to come out and say that than the opposite.
I'd rather you give me permission up front to underestimate what you're doing. Don't ask for forgiveness later when you said, hey, it was worse than we thought.
Yes, and the sort of phrase I'm hearing a lot recently, both from companies and also investors, is scenario modeling, right? Like what kind of the decision tree or all the branches and the different scenarios that could take place, and what do you do in each of those scenarios?
Yeah, it's risk mitigation, but getting back to what David Wagner was talking about, I'm most surprised by that 2026 guidance yet, that it hasn't come down yet, the estimates for earnings. Look, I believe in the long-term resiliency of these companies if we get tax cuts, or at least keep the tax regime that we have, that's going to be a back half of the year catalyst. But just the revisions haven't changed, and I think it's more important for the unmagnificent 493, right? They're supposed to show about a doubling of the earnings growth rate. If that evaporates, then the whole underpinning of this market broad-based rally evaporates with it, because then it's just back to the Mag 7. Do they have the ability to sustain the rally for the market forever and keep being the leader? I don't think so. I think we're seeing cracks in that thesis.
Okay, well, that's a little worrying, Glenn. All right, we'll talk more about it. Retail is among the sectors, of course, that's facing an uphill battle navigating President Trump's trade war. Retailers like Carter's and Skechers withdrawing their forward-looking guidance, citing macroeconomic uncertainty, and the tariffs adding another pain point for the ever-shifting retail landscape. Here with more on what's ahead is Storch Advisors CEO Gerald Storch. Of course, he was also former chairman and CEO of Toys R Us, an executive at Hudson's Bay as well. Jerry, it's always great to get your insight into these matters. I'm sure that you are having a lot of tough conversations with your former colleagues in the retail space right now about what they're experiencing. What to you is the sort of biggest pain point for them right now?
Well, it really depends on the company. If the hardest hit are retailers who are selling footwear, apparel, products like that are heavily imported, heavily from China. If they didn't diversify their sourcing base away from China like they should have done after the first round of the Trump tariffs, then they're getting hit very, very hard by this. And it's difficult actually to have a short-term answer for it. If they did, then they have a lot of options. And so I think people are scrambling, looking for sources of manufacture outside of China, because it's not so bad in the other countries. in terms of how high the tariffs are. They can handle that. And also looking for domestic sources of manufacturing. Meanwhile, there's almost nothing coming from China. You'd be almost foolish to do, you were talking about decision trees, to follow the branch that says, I'm going to bring it to the United States and pay this doubling or tripling of the price. And then the rug might be pulled out from under me tomorrow if a negotiation should be successful. So that's not happening. So I think you're seeing a significant retreat from purchases and imports from China.
Jerry, I just want to thank you for making Toys R Us a staple in my youth, very nostalgic. Did have a question for you, though, regarding some retailers that may have some more insulation or buffer to weather some of this tariff uncertainty. Are there any pockets of maybe more safe opportunities? Maybe it's companies that are more dominated with online sales versus brick and mortar. From your vantage point, is there some area we should be focusing on as investors?
Of course. And I believe that that when you've looked at what the market's done, there has been differentiation in terms of what's happened to the share price. People have kind of figured out some of this, though I think net, it's more likely this is an overreaction than an underreaction to what we're going to see in the future. But companies, for example, that are heavily into consumables that are manufactured in the U.S. or food companies, aside from bananas and coffee, there are substitutes available domestically. So I think a lot of these companies like Walmart or Costco are very heavily insulated, frankly, in terms of the overall impact on their business. Certainly there are sectors within their businesses that will be hit. And a company like TJX, even though it's apparel, they thrive in an environment where the mainstream apparel sellers are making a lot of mistakes or having a lot of problems. So they should continue to do very well. And by the way, their stocks held up pretty well during this period. So it's not true that all of retailing is bad. I see these pictures online or in newspapers of empty store shelves, and they claim that's what it's going to look like in a few months. You'd have to think that these retailers are pretty stupid, frankly, or that capitalism doesn't work to think the shelves are actually going to be empty. I think that's what you're going to see. You're going to see maybe substitute products. You're going to see people using this as an opportunity to get rid of their clearance that they need to get rid of. I think other than companies that are very specific, like say having specific parts that you need there's only one part that serves this purpose. You're not going to be seeing widespread empty shelves. That's just an absurdity when I see those pictures.
I mean, to be fair, we saw widespread empty shelves during COVID, right? So because there is this notion that at least when we're talking about goods from China, it won't be that they're even still coming in at all, that there is this sort of pause or freeze in orders. But I guess what you're suggesting is even if there's a freeze in orders from China, that most of these retailers have with COVID, it was everywhere, right? You're suggesting these retailers have a diverse enough supply chain, most of them, that even if they can't get, say, T-shirts from one place, they'll manage to get it from another.
Yeah, COVID was a totally different situation, but the empty store shelves that I recall from COVID actually were the domestically made products like toilet paper,
right.
Things that people, where there were runs on them, sort of panics that took place. There wasn't any need for it in most cases, by the way. It was totally manufactured or sort of hyped type of a problem even then. But there weren't empty store shelves throughout the store. That's just not true. It's things that again, someone read an article somewhere that said you'd have problems if you didn't buy 12 months of toilet paper, and something did. Things like that. So that's all bizarro time. Where it's similar to COVID is that once you get a supply chain out of whack, it takes a long time to get it back. And so what you do see is people sort of panicking, that it's retailers, manufacturers, and moving to other sources of manufacture, buying other things. If they can get something, grabbing it, even if they may not need it in the future. So there are big risks that their inventory is going to be out of balance as we come out of this. And you have to think we're probably going to come out of this, that there will be some negotiated settlement of this in the intermediate future, if not more quickly. And so when that happens, people are going to be found holding very different decks of cards based on how well they played this, how well their decision trees were used to calculate what they should be doing. So everyone's not going to be in the same place. And there, I continue to bet on the same people, frankly, Walmart, Costco, TJX, that have been delivering, year after year, period of time. Or someone like an Amazon, who, even though they're getting hit hard in the marketplace area because a lot of these Chinese goods that they're bringing in and selling through the marketplace that are not going to be there. They can sell everything. That's what they do. They're a marketplace, so they'll put other products on there that they will sell.
Right, exactly. Jerry, good to see you. Thanks so much.
Yep, my pleasure.
Well, the Justice Department wants Google to sell its Chrome browser and potentially its Android operating system, among other remedies. Some companies have already expressed some interest in buying Chrome if it does indeed go up for sale. For more, we've got Yahoo Finance's Alexis Keenan, who, as always, has been pouring through the court filings. What have you found, Alexis?
Yeah, Julie. So the interest in acquiring the internet's most popular browser, that came in some testimony in court in the remedies phase that is in trial now, that the DOJ won against Google last year. And so this remedies phase, it's really meant to help the judge figure out how to restore competition in search. So there was some testimony from Google's competitors. We had executives from AI-powered search startups. You had Perplexity's executives, Microsoft-backed OpenAI's executives, all expressing interest in Chrome. We also had Yahoo's own general manager for search, Brian Provost. He told a judge that the company would like to put in a bid for Chrome. That is, if it is put up for sale. And that would mean a judge orders it be put up for sale and divested from Alphabet's Google. Now, today you also had a vice president at Microsoft's Bing testifying that the key to search is really distribution. So that's where Chrome comes into play. The testimony was that, these companies, these search competitors to Google search, they want their own data. They don't want to have to rely on necessarily Google's index. So there's a lot of debate about the impact of what a Chrome sale would really mean for Google. Google, for their part, they say that it would hurt consumers, that it would hurt the economy, it would hurt innovation, that it would risk the fact that Chrome's underlying open source technology could be shuttered by a third party, a new buyer, and also that the privacy and data security that Google provides, that could be jeopardized too. Now, I spoke with a data scientist who said that he disagreed. He thought that Google could easily withstand a Chrome divestment, that really traditional search, he said, was a dying market. In a couple years, 1-2 years time, that everyone will have shifted to AI-powered search, and that Chrome, once it's decoupled, if it's decoupled from search, that makes Chrome just inherently less valuable from the get-go, and it really hastens the demise of that traditional search. Now, that all would be maybe a much bigger problem, though, because another thing the DOJ has on the table is wanting to limit how Google uses its own AI to boost up its own products. They want there to be some sharing there with competitors. So a lot is in the mix here, but we continue to watch the testimony as it comes out in the remedies phase here. And the judge's decision is expected following the testimony in August this year.
Okay, the clock is ticking. Thank you, Alexis. Appreciate it. Now time for some of today's trending tickers, and we want to talk more about Alphabet and that possibility. Of course, we're looking at their earnings, but also there is this trial hanging over the company. Yesterday, we spoke to D.A. Davidson analyst Gil Luria, and he talked about the potential breakup of Google and why he thinks maybe it should happen.
The Department of Justice is hell-bent on Google not having a monopoly going forward. So breaking up the 3 monopolies that it says Google already has in order to prevent Google from having a monopoly going forward with chat. So instead of Google dragging its feet, which is what it's been doing so far, we think Google would be better off being proactive, spinning off these businesses. It would probably release value to shareholders.
So let's do a deeper dive now into Alphabet and Tesla. And guess what? We have an Alphabet bull sitting right next to me here in the form of Lou Bassanese. I want to ask you specifically about what Gil was just saying there, this idea that maybe they should get ahead of it.
Wholeheartedly disagree. Why would you give up your assets willingly or spin them off? I mean, I think in this case, the sum of the parts is not better separated. It's part of the whole. I think you create more consumer confusion than encouraging competition if you divest Chrome. I mean, let's be fair. What other search engines are you going to use? I mean, it's so embedded and entrenched. It's synonymous with the word search. Is there really going to be an upstart that does it differently?
Well,
right?
maybe there wouldn't be another search. Maybe the the search paradigm just changes to generative AI, for example? In other words, maybe it's not another search quote unquote company, maybe it's Perplexity, or maybe it's ChatGPT.
But I'd argue that'll happen with the natural evolution of AI, right? This becomes the next S curve of innovation where search is now it's the waning end of it, and we're going to jump to generative AI, and it doesn't matter, right? So from that standpoint, from a shareholder standpoint.
From that standpoint, I guess you don't have to break it up because there's competitive pressures coming anyway.
Exactly. And so I think from that standpoint, I think that's why the stock is so cheap. I mean, relatively speaking, it's at about 17, 18 times forward earnings. A year ago, it was at like 26 or 27. It's this threat of being broken up, being forced to not pursue the dominant position that they've had, and having that protected. I think this latest report showed exactly why you want to own it, right? AI is contributing to better advertising results, which will lead to, even in uncertain economic times, marketers continuing to spend on marketing, which is just
You don't think ad spend is going to pull back?
I mean, ad spend ironically always pulls back in a recession, which makes no sense. Like if you have a business and advertising drives your business and you know you're going to a weak spot, why are you going to stop advertising, right?
You don't have as much money.
I agree with that, but I think it has to be moderated. So I think you see an overreaction traditionally. Like I used to traditionally think of Meta as a great short in a recessionary environment because 98.9% of the revenue was all advertising, right? And people cut back. So yeah, I think there's some risk there, but I think what you're doing is you're counterbalancing that risk with AI improving results.
Gotcha.
So if I think that I'm not going to make as much, but then I can use AI-based search to make more, I can bridge that gap. So.
And you own Alphabet.
I do, full disclosure.
All right, let's talk about a stock that you do not own, I don't believe.
I do not.
And that's Tesla. It did surge as much as 10% today. The Department of Transportation rolled out a new framework for self-driving car regulation, including what it's saying is streamlining some reporting requirements for cars equipped with automated or driver assist systems. There was also some reporting out of India that Tesla had made a move sort of canceling people's deposits on Model 3s. That was seen as perhaps a precursor to selling cars there, maybe. But regardless, Tesla is a bigger story than just these two headlines that we're talking about today.
It is, and for me, it's a decision of, do I invest based upon, do I think this is a car company or a technology company? I come down on the side that this is nothing but a car company. Again, the revenue determines what type of company it is, right? 90% of it is related to automobiles. The other 10% power storage, and maybe it's the new technologies that the bulls want to lean into, right? So the other side is, hey, this is not a car company. The automobiles are the platform to deliver self-driving cars, artificial intelligence, and everything else that we want to think about. That falls apart, though, for me as an investor, because there's other opportunities where I don't have to buy into the future promise and potential and pay up for it. Like Tesla's trading at valuations that in this market, I feel like I can get better bargains. I mean,
even after the collapse in its stock.
Even after the collapse, and like this is what I was saying. I think I shared it with Madison. Like the Mag 7 is a boy band that needs to desperately break up. It's not a singular trade anymore. It's not a and I think this is a bifurcation here. Get rid of Tesla. You focus on the Alphabets of the world. Apple situationally when it pulls back too sharply. I don't think it's a block that you can just own and hold. If you haven't been doing that already, right? I'm not advocating just go get out of what you've held, but if I'm putting new money to work, I'm going to be biased towards value and real earnings and revenue, not future earnings and revenue.
So now my gears are turning like, okay, which boy band member is Tesla compared to?
Joey Fatoni's in there somewhere.
I don't know my boy bands well enough to have the one-to-one comparisons there. Let's stick around. We got much more market domination coming up. Saint-Gobain shares rising today after the French supplier of construction materials posted better than expected revenue for the first quarter. It also reaffirmed guidance amid tariff concerns. For more, we've got Mark Rayfield, Saint-Gobain North America CEO. Mark, it's good to see you again. Thanks a lot for being here.
Nice to see you as well. Thanks for having me.
So as we've talked about before, but just to reiterate here for our viewers, you guys are not very exposed to tariffs because the construction materials you're selling in the U.S., roofing, drywall, et cetera, is pretty much made in the U.S., right? Talk me through, kind of the flow of your supply chain, just briefly for people who aren't familiar.
Sure, I'd love to. So we have about 60 plants in the U.S. and 30 plants in Canada to service those local markets. We manufacture the roofing and gypsum very local to where they're supplied. So we have plants in Florida for the Southeast and New England for the Northeast. They're very heavy products. The raw materials are local. The customers are local. So we're not very heavily impacted by tariffs at all. There's some very minor raw materials that may cross a border here or there, but really we're a local business for local customers.
So I have a question for you. Julie and I were here discussing right before you came on just what's next for the housing markets, right? We see this kind of conflicting data that's an uncertain path. Who better to ask than someone that serves that directly with supplies? I mean, how do we make sense of the fact that we have more finished homes right now in the U.S. than we did right around, pandemic levels, right? The last crisis.
Right.
And is it a pricing issue? Is it interest rates? Is it a supply, inflation? Where do you come down on that? And what is the factor that breaks the levee so that housing really rekindles its growth?
Yeah, I'll give you an opinion. I think the answer is a very difficult answer, and I probably don't have the correct one. I mean, the reality is there's so many different indicators going forward. What we look at is the basic fundamentals of housing are strong. The family creation, the underbuilt concept of about 2 to 3 million in the US and almost 2 million in Canada of underbuilt homes. So there is a demand there. There's a need there for housing in the short, mid, and long term. You have lots of different numbers coming out. So you have the very low new existing home sales number that just came out this week. When you look at that, you can say, okay, this is the end of the world. If you look at the other side of that, you could say, okay, inventories now are building up to a normal level of homes for sale. That's bringing prices down below inflation, which is making affordability, which has been one of the bigger issues, off the table to some degree. So I think when interest rates get to 6% or so, you have a releasing of a lot of activity. And then you have a consumer confidence issue that kind of touches on everything from that perspective. Having said that, a lot of our business and a lot of the business in the building materials business is renovation and remodeling. And you can take the same both sides of the coin view there, that when you sell a house, you remodel it before you sell it. When you buy it, you remodel it so it fits what you want. By the same token, if you stay in it longer, decide not to sell because you couldn't find the right house, you again remodel there like we saw in COVID. So each indicator that we look at has kind of a counterbalance to it. And what gives us comfort is our great results in the first quarter and the fact that over 2/3 of our business is renovation, remodeling, and a good portion of that is non-discretionary. Your roof leaks, you replace your roof. Your siding's damaged, you replace your siding.
And so, Mark, is that the case even if there were to be a recession? And I want to ask this question not just for the United States, but for Canada, which is a big market for you guys as well, and which is definitely at risk from tariffs. So when you start to see, even if it's just shy of a recession, say, if you do see an economic pullback, we already know that consumer sentiment is lousy. How do you expect all of that to affect spending on your products in this market and in our northern neighbor?
Well, I think, what we're seeing in Canada today is actually kind of surprising. We're seeing an uptick in housing right now there. So they're actually having a good swing up off of a low base. But if there's a recession, it would probably impact everybody. But again, it doesn't impact renovation and remodeling anywhere near the level it does new house building. And it doesn't impact non-discretionary spending, which most of your roofing, a good portion of your siding is in that non-discretionary side of the business. And a lot of your commercial projects where your gypsum and insulation go into are long-term projects that are started. So, I mean, you're always looking at the economy, looking at risks going forward, but in essence, and I do the same thing you do, look at all the reports coming out every day, and part of your body goes, oh my God, this could be really bad here. Then you go back and look at the counter side of it, and then you look at what we're seeing in the market, which is still good demand. Some of our businesses are still sold out, and we're still seeing good pull through under distribution and into the marketplace.
Yeah, I guess, what are the negative potential risks for the business? Because I sit here not very accustomed with your company, and now I am intrigued because you're essentially a consumer staple in the real estate market, right, for non-discretionary spending. You're not exposed to tariffs, which is a complete rarity today. Is there a valuation concern? What do you see as the potential risks that could change the business for you?
I think they evolve. I mean, there was a risk when interest rates were going up that people were waiting for lower interest rates. I think that settled a little bit. I think now people might be thinking, 6 on the interest rate versus a 3 is a good interest rate. So we're closer to that number going forward. You have an affordability index. So again, the number of homes that are on the market now increasing, while it can be viewed as a negative as far as month-on-month sales, actually is bringing deflation into the marketplace, making it more affordable from that perspective. And then there's always, on a good market, the challenge we look at is labor, making sure there's enough labor to build and renovate homes going forward. And that's always kind of has been the point of inflection, so to speak, on when the housing market picks up that can slow us down.
Mark, good to catch up. Thanks for joining us.
Yeah, thanks for your time. Have a great Friday.
You too. Coming up, Amgen is becoming the latest drug maker pledging to increase U.S. capacity amid looming tariff threats. We'll get you the details and discuss the best ways to be positioned in the pharma sector on the other side. Stick around, more market domination still to come. Amgen today announcing a $900 million expansion of its Ohio biotech manufacturing facility. Yahoo Finance's Julie Hyman joining us now with the details on this. So this is the latest, right, of this sort of reshoring of pharma manufacturing.
That's right. And you can see all these companies basically jumping in line to make announcements for things that may have actually already been pre-planned or in the works for a number of years or months. Amgen is the latest for that right now with that $900 million expansion, in addition to a $1 billion announcement last month, I believe, or a little bit earlier for North Carolina. And so that just adds to what we're seeing. There you see it on your screen. And that adds to what they've said is like a total since the Tax Act of 2017. And that's something that I found kind of interesting, was something that has been happening. If you take a look at the numbers for all the different companies that have made announcements in the recent past, the largest by far, $55 billion from Johnson & Johnson. And then on the smaller end, moves like Amgen as well. And this is being credited to some of the moves that they've made as a result of the Tax Cut Act in 2017. So it seems like maybe some of this is, tariff fear and trying to, play towards the administration, but it also seems to be attributed to ongoing CapEx.
Right. Yeah, and it's interesting. I do wonder as well, one of the things that we've tried to suss out when lots of companies come out and make these announcements, was it things they were already planning?
Exactly, yeah.
That now
these increases or new?
That now they are making these, maybe with more fanfare in order to, sort of curry favor or conversely not incur the wrath of the administration.
Definitely more fanfare. I mean, we saw the Eli Lilly announcement for that $27 billion in DC of all places. The $55 billion from J&J is a huge number, and largely in earnings, these used to just go by like it's just a single line item. You would never hear them call it out and make sure to ensure that it's in the press release, it's visible to folks like us. So,
how much more expensive is it for them to do their manufacturing in the U.S.?
That is something that we are just getting a handle on. It also depends on what specifically is going to be taxed. That's the part of the equation that is still unknown. We know that there's a report out, I believe, today that looked at, what the overall cost would be, something in the ballpark of $51 billion. But if you're looking at that, that just talks about the whole cost of the product. And so the portions of it, which is somewhere in the ballpark of 30% that comes from China and India and the like, and then you've got, 70% of all products coming overseas. It's a very big mixed bag. And so piecing, getting those pieces out is still in the works.
Yeah, and Anjali, Novavax shares sinking today. What can you tell us more about what's going on?
Yes, poor Novavax. They have really been, since this company tried to come out with a vaccine, it has just been under pressure. Still on the topic of its COVID-19 vaccine, the FDA taking a second look, asking for a new trial. And this is just as the company was about to essentially hand the reins over to a partner, that's Sanofi, to get the product commercialized and finally approved outside of authorization. So just another speed bump essentially for
or
this.
sign maybe to give it up, and a couple other names that were advancing and getting regulatory pressure, just let go of those.
Well, we did see already the pullback from the Trump administration on next-gen COVID-19 vaccines. So there is definitely a focus on this specific product line.
Right. Anjali, stick around because we're going to keep talking about pharma. A recent report saying the U.S. pharmaceutical tariffs would raise U.S. drug costs by $51 billion annually. That's according to Reuters. That report's tied to pharma companies like Amgen, Eli Lilly, and Pfizer, and it could affect the stocks going into the second half of the year. We're navigating how to play the pharmaceutical sector with the Yahoo Finance playbook. Joining us now is Tim Anderson, Senior Pharma and Biotech Analyst at BofA Securities, and our Anjali Kamlani, Yahoo Finance Senior Health Reporter, is still with us as well. Tim, thanks for being here. So we were just talking about this cost equation of these companies trying to reshore, but obviously that's going to take time. So let's take a snapshot of what's happening right now, given the tariff landscape. What do you think is going to be the hit to your covered companies, and how are they navigating it?
Yeah, so the companies haven't really quantified this at all yet. When we do kind of back of the envelope math, I think that if tariffs went through and you really had things like a 25% tariff or a 20% tariff coming out of Europe, where you manufacture commonly in countries like Ireland, you're probably looking at an earnings impact that would be, maybe somewhere in the single-digit percent. No company has quantified it at all. It's not surprising because we don't have any firm specifics on the policy coming out of the administration. So until you have those, all you can do is really, rough back of envelope math. It is the topic, number one that's coming up on earnings calls. And despite incessant questioning, you're just not getting a whole lot of answers.
That's definitely true, Tim. Angela here, I know that for Johnson & Johnson specifically, they did talk about the med tech impact. I know that's sort of a carve out or sort of a different subsector for some of these large cap companies. I'm curious, they've been talking about working with the administration, a potential carve out. Could that sort of rein in some of the, the guidance that we're seeing and some of the hits that we're seeing to that subsector?
Yeah, well, I don't cover the med tech space or the medical device space, so it's really just on the pharma side. In terms of a carve out for pharma specifically, or drug producing companies, I really think at this stage everything is potentially negotiable. If you listen to what Trump and the administration is saying, when they're talking about national security issues, it's really a reference to China. It's not obviously to countries like Ireland. So I just don't honestly know what to expect is going to actually become firm policy. And then from there, you'd have to see how the companies adjust. And along the way, how they can kind of negotiate more favorable terms. So as you probably know, the government started this 232 investigation. There's some time that will elapse. It can be on the order of months. It probably goes faster this time around with Trump. But during this window, I wouldn't be surprised if the industry is, in the hallways trying to negotiate the eventual outcome.
Tim, I had a question for you. It seems like every 5 to 7 years in pharma, we get a new hot mechanism of action or class of drugs. Before the GLP-1s, it was the immunotherapies and CAR-Ts. Where in your mind are we in that phase of the trend with GLP-1s? Are we at risk of getting oversaturated like we saw with Merck's Keytruda, where there was, call it 2,000 combination trials underway, or are we still in the early innings of growth and opportunity in the GLP-1s?
Yeah, so, obesity is certainly the hot, big category. It probably ends up being the biggest category ever. Currently dominated right now, 2 companies, Eli Lilly and Novo Nordisk. And those companies will have such a moat around them that it will be very difficult for late entrant companies to take much more than just marginal market share. So you're really not looking at anyone else coming in, most likely until something like 2028. And then it'll be a flood of products, but they won't really change the market. So where are Lilly and Novo now at the moment? I'd say, use the baseball analogy, still in the first inning, maybe the second inning at most. So you've got a lot of innovation that's still ahead in terms of new drugs that are being rolled out. Even though we're still early on in rolling out the current products, both companies are already on 3rd generation products, both injectable and oral. And so it's going to be kind of a constant stream of innovation that, again, I think those 2 incumbent companies will dominate. So commercially, we're rolling out. The US is the most advanced market so far in that front. Even there, it's early. And then internationally, we're just barely scratching the surface.
And Tim, I believe Eli Lilly is one of the stocks that you have as a buy-rated one. Is the obesity piece the main impetus behind that? We're going to hear from the company, by the way, reporting next week, May 1st, is coming out with its numbers. Or are you looking at it more as sort of a well-rounded play?
I'd say, Lilly, absolutely the driver is obesity. Right? It's going to dominate the P&L. It's going to dominate the story. It's certainly going to dominate the news flow across biopharma in 2025. It is more diversified than their incumbent competitor, Novo Nordisk. And so I do think that does give a measure of comfort to investors. And in the other areas where they play, like oncology, they have a good, stable, growing, performing book of business. But, don't be fooled. Obesity is really what drives the bus. And that, the good thing for Lilly is that that really provides them not only a high level of growth, but a durable P&L over the course of a decade, really. And the industry, one of the problems the industry faces is you get into the late 2020s, there's so many big patent expiries that start to poke major holes in income statements. And Lilly just sails through that period because of this wave of obesity growth that's ahead of them. So not only is it a high level of growth, it's a durable level of growth. And for the reason I talked about earlier, it's pretty insulated from competitors.
And I know we're also watching to see if it becomes the first $1 trillion healthcare company. We'll see. We'll see about that. But Tim, question for you on healthcare broadly as a sector tends to be thought of as safe during recessionary periods or during volatility in the market, and we're not seeing that anymore, in part because of the drug pricing pressure in the past year, as well as on the biotech side, funding cuts, a different level of interest waning from investors. So I'm curious, how should we think about healthcare now, and does it kind of move away from being sort of a safe sector?
I think it moved away from being a safe sector 15 years ago, 20 years ago. It's heavily regulated. There's so much binary event risk with these names. Usually what gets people excited about drug stocks is a phase 3 trial about to report out or a new drug about to make it to market. And that just embeds risk, right? Most of the time those drugs are going to make it, but you're still left with something like 30% of drugs in phase 3 that ultimately don't make it. So that sort of thing creates a lot of volatility in the sector. And politically, you've been under attack for drug pricing. So we see that in the current administration and many prior administrations before that. So it still acts defensively. You don't have to look any further back than 2 months ago, 3 months ago, when the markets were starting to melt down and there was this kind of flood of money coming into pharma. But then Trump starts talking about drug pricing and tariffs on pharma. And I think that it kind of reminded investors it's not the safe sector that it used to be a long time ago. So I do think it's changed a little bit.
Tim, really interesting insight. Thank you so much, and thanks, Anj.
Thank you.
We're wrapping up today's Market Domination, but don't go anywhere. We got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.